Moritz, welcome. Thank you so much for accepting our invitation. I hope you can hear us well. So Moritz is the president of the Kiel Institut for the World Economy and also professor at Sciences Po in Paris. Is a well-known economist. I was going to say German economist, but that, I mean, you're a well-known economist in general. You are also German, and you have been writing, important academic papers in macro and finance. I would not spend much time, going through all your achievements. I just want to remind everybody that the Kiel Institute for the World Economy is part of a network. I guess you're going to say something about that, of German institute, including the IFO, that we usually call IFO in Italian, the ZEW, that we usually call ZEV in Italian, and the EIW, that we usually call DIV in Italian. And these four networks are very much involved, as you are actually, also individually, in the policy debate in Germany. So, Moritz, very welcome, and please, so you will have about 25 minutes, and then we will open up for some questions to you. Please, the floor is yours.
Thank you very much, Lorenzo. I hope you can hear me. So, buongiorno tutti from me, from Berlin today as well. Very pleased to be with you and talk about the German economy for the next 20-25 minutes. And I'll start with a picture that it might have made it to the Italian press and media as well. I'm talking about the German economy, an economy where quite a few things have changed quite dramatically in quite a short period of time in the last few weeks. This picture is Friedrich Merz, and he picked up a line that originally came from a very achieved Italian economist, Mario Draghi, the whatever it takes line. And this whatever it takes was what Friedrich Merz repeated, or this was said, and obviously knowingly quoting Draghi the day after we all saw the images out of the White House and the big shift in the security policy of the Trump administration. Said whatever it takes, Germany and Europe now have to take questions of security and defense into our own hands, as we cannot rely anymore to the same degree on our American partners. And this shift, I think we at the Kiel Institute have done quite some intellectual groundwork, starting at the Munich Security Conference last year, to prepare this shift in German sort of the defense and security outlook has led to a major shift in the fiscal outlook. I will talk about this a little bit in the next minutes, but essentially, and you will have seen this, Germany lifted in a recent constitutional change with the outgoing parliament still. It lifted the long-standing debt brake, the famous German constitutional debt brake, for defense spending, for everything above 1% of GDP, and defense spending can now be exempt. It doesn't have to, but it can be. And, knowing politicians, that probably have a big incentive to actually exempt it from the debt brake, finance it via additional borrowing. At the same time, we have Friedrich Merz and his likely coalition partners have introduced a new special fund, again, a debt finance special fund of about 500 billion in total, to be spent over the next decade, more or less, for infrastructure, an infrastructure update, an upgrade of the German economy. 500 billion, half a trillion sounds like a lot of money. And it clearly is, but if you break it down over 10 to 12 years, actually, if you also take into account that roughly 100 billion of this goes to the individual regions, and another 100 billion is earmarked for energy and decarbonization. Then the upgrade is going to be roughly 300. The money, the pot for the upgrade of German infrastructure. In other areas, we love to have the very nice fast train systems that you guys have running now. There's about 300 billion left, which is not negligible. But if you divide that by 12, you also end up with amounts that I'm just saying this to make the case that it sounds like a big number. And it clearly is a significant shift in the German fiscal outlook, but the infrastructure package as such is not something that changes. I think sort of the German fiscal sustainability or even debt to GDP ratios probably will not increase. I would say meaningfully. Beyond 70% of GDP over the next decade. The big game change is really the defense, where Germany has now the precondition. There's no longer going to be economic or financial impediments to upgrade and build a joint European defense. You mentioned earlier that we have these research institutes, and actually we played, and I was part of a group of 4 economists who kind of wrote the blueprint for this compromise between the conservatives and the social democrats. The conservatives wanted to have more money for defense, the social democrats more money for infrastructure. So I mean, it wasn't a very hard moment, but we wrote it down in an email to the coalition partners, and they picked it up and ran with the idea to effectively implement what's been implemented now, namely have both more money for defense and an infrastructure fund. I'm showing you, this is the original email that went to the, it's in German, but it's the email, the 12 points that went to the coalition partners. And it essentially says, like, do these 2 big pots of money. They're both on the defense side is absolutely necessary. On the infrastructure side, if you spend it well, it can give a boost. We also talked a lot about making sure that the investment that was already allocated or planned in the budget for the next years would not be diluted. So there is an additionality criterion now in the Constitution, so they can spend the additional infrastructure money on additional investments, not replacing existing investment outlays that were already in the financial plan. So that was something that had to be clarified in the past couple of weeks before the constitutional change. The German word for this is sort of a station where we arrange trains, so you avoid this, that you can shift just some investment spending into the special fund and then free up funds in the normal budget to give out the election takeaways to pensioners and others. So we've avoided that at least more or less, and there is a new fiscal arrangement now that the new government, which most likely is going to be led by Friedrich Merz in a coalition with the Social Democrats, can use. Let me also say something else that connects, which is the international environment in which we are looking at from the Kiel Institute at the German economy over the next year or two. Obviously, the thing that's on everyone's minds is the US, is Trump and his trade policy, his deep affection for a chaotic tariff policy announcements. We just had one 2 days ago on 25% on European. On all automotive imports, we should say, and we have actually it's a public good, and it's all in English. So if you're interested in this, in Kiel, we have we call it the KITE. It's the Kiel trade model. It's a quantitative general equilibrium trade model with lots of countries and lots of sectors. So we can also simulate in this sort of general equilibrium setting what happens if there are sectoral tariffs that are imposed, and it's set up so that we can really run it very quickly and get the results. So here, what I show you are the results. What happens to exports if these 25% tariffs on US automotive imports go into force next week, assuming they will not be negotiated away. And you see the different European countries, and you also see the effects on countries like Mexico and Canada. So for Germany, we think that total German exports will fall by only 0.5%. That doesn't sound much. France, half of it. Italy, also around minus 0.2%. That's not a lot. Harder hit are Mexico and Canada. That's total exports. So we go on to real production, basically GDP change. We think this 25% car tariff will subtract roughly 0.1, will somewhere between 0.1, 0.2% of GDP over the next year or so. For France and Italy, we find the effects to be very small, owing to the larger exposure of German, especially the premium car makers, to the American market. Again, most hit are Mexico and Canada. This being said, so keep this in mind. This is like something that happened over the last 2 days. So we've updated our trade model. We have done a forecast for the German economy for 25, 26, 27 about 2 weeks ago, where we had assumed that we would get something like a 5 to 10% general effective tariff increase. So we've baked in some of the Trump policies. We hadn't baked in a 25% tariff. We haven't baked in potential, potential an acceleration or an intensification of the trade war. But if I show you our forecast now and discuss them, keep in mind that I think the fair thing is probably chip away 10 basis points or so, minus 0.1% of GDP to the 10 basis points from the growth forecast for GDP. Maybe a little more, maybe a little less, but around this, it will shift the numbers a little bit, but not making a big difference. At least if we stuck with these 25% tariffs. Okay, so here's our forecast. Going both showing you the past performance, which, as you know, was really bad. 23, 24, we had basically stagnating, slightly negative growth rates. For this year, we think it's going to be another year of stagnation. If you ask me personally, is the upside to the downside, the risk to the downside or the upside? I would have said to the upside, just because of the sentiment that with the fiscal package domestically, things seem to be moving in directions. Companies seem to be happy. The expectations and optimism has been picking up. But then obviously you have the trade side and you have Trump. So I think probably the baseline of another year of stagnation is not bad. For next year, we've increased our growth forecast to 1.5%, owing to the fiscal loosening, also the fact that we'll have a full budget again. Remember, for 2025, we don't have a budget yet, so everything is kind of, budgets are executed, but nothing new is added. So from that 1.5% number for next year, you maybe want to take down 0.1 or 0.2% for the car tariffs that have just been announced. But it would still be a year with growth of 1.3, 1.4%, so not bad at all, given recent growth rates. This is real. If you add 2.5% inflation, the German economy will grow again at 4% nominal, maybe a little more. So it certainly will be felt domestically and by German companies. What does it mean for capacity utilization? Well, we still think that this year, after the bad years, there is a little bit of an output gap that will close slowly. EFO capacity utilization will bottom out and then pick up again going into 2026. So there is some spare capacity, also important for things like defense, a ramp up, which I think is the really big driver that will kick in. We will convert a lot of industrial capacity into defense capacity over the coming year or two. And I guess the urgency for these questions is not as clear in Italy, but I can tell you here it is the #1 topic. And the transformation of the German economy and the German industrial base towards a much more defense high-tech production capabilities will be, I think, one of the dominant themes of German economics in the next few years. Everyone has realized that this bears enormous opportunities to upgrade the German industrial and technological capabilities. If you think about mass production of drones, if you talk about network systems, artificial intelligence, satellite constellations, rockets, iron domes, all of these are, it's obviously this whole space program, all of these are total high-tech sectors that could give German industry the sort of the technological boost that and the growth potential that it needs, and the demand also that it needs to grow and diversify away from, you know, a more traditional machinery and luxury cars and other sectors. So this is a big story. This is a transformation story. Now with the fiscal package, there is, if you will, there's unlimited, almost unlimited upside for demand going forward, depending on, obviously, also on the geopolitical situation. Let me continue with what does this all mean for exports. Again, this year -2, we're still in sort of overall negative territory, going more positive next year. Imports, also owing to the fact that we'll spend more domestically, will grow at a faster rate. So the trade balance is going to, the trade surplus is going to shrink. What do we think about private consumption? It's going to remain rather muted as the you know, the uncertainty also over the geopolitical situation lingers on. Construction investment, we think, will make a return. It's been a very weak part of the German economy. You see these -4, -3, -3, this year -1. The higher interest rates, we remember we didn't have a special bonus for construction or home improvement. The higher interest rates really, I'm not saying killed, but really burdened the construction industry. And after 4 years of negative growth, we think next year the pickup in construction with a real growth of about 4% will be very substantial. Equipment investment, same story, was weak last year, especially weak with all the uncertainty also over energy price and trade policy. This year, some stabilization, and we think there's going to be almost a 5% rebound in equipment investment next year. At the same time, economic policy uncertainty is something that you know, we monitor closely. It is high. There is a lot of big shifts happening right now in Germany, both on, you know, the future of the decarbonization, energy transition, the external environment, the transit defense industry, the potential, if any, for structural reforms which are badly needed in terms of deregulation, debureaucratization, and also in terms of pensions and the social welfare system. You might say, and I think you would not be wrong, that with all this money now available to policymakers, the incentives to actually do reforms that hurt will be much reduced, and that obviously is one of the big risks. The reforms are necessary, however. Coming to prices, we are generally, despite the fiscal boost, generally quite relaxed. I told you there's still some spare capacity built in. We also do think that overall, obviously the ECB will do what the ECB does, but we do think they are still, with the level of policy rates right now, they're still in restrictive territory. So, you know, there's some debate about how easy ECB policy already is. We don't, subscribe to the view that whatever the natural rate has moved up or has moved substantially. It's moved maybe a little bit higher, but relative to where the economy stands, we would say that ECB, the stance is probably still a little bit restrictive, maybe going towards neutral, but it's not there's no expansionary, so we don't think that inflation will pick up meaningfully. There is a debate, and I don't want to let a drop under the table about if you put all that money into defense, what will happen to prices and capacity utilization. Again, I'm also happy to discuss this, but I think from past defense buildups, we know how quickly defense capacity can expand, and how much the also industry, once you go from sort of basically hand manufacturing individual rockets to industrial scale mass production, how unit costs come down, capacity can be ramped up. There are plenty of historical examples, so I guess we're slightly less worried about that, especially since so much of future defense is drones and not tanks and not steel and just a very new way of hybrid, also electronic warfare that will be much less affected by traditional worries about capacity constraints, etc. But I'm happy to discuss. That's obviously a big question. Employment next year, with the return of growth, we think employment growth will turn positive again. This year we're losing a few workers, but it's not a big change given demographics. Unemployment is the opposite, obviously, and changes in the labor force, but unemployment will go down by roughly 160,000. Let's maybe the last few 2 minutes or so that I have, let me talk about potential. I think on potential, we're probably on the pessimistic side. I'm happy to talk to you about why that is, but you see, I mean, basically this is a traditional, very traditional decomposition of growth rates into capital inputs, labor inputs, and total factor productivity. So how much more do we invest? How much more workers and labor do we put in, and how do we grow? How much do we grow because of a better combination of technology, labor, and capital? And you see that in the 2010s, Germany had very solid productivity growth. I mean, solid by sort of European standards, percent or so of growth, almost 70, 80 basis points came from a productivity growth. That has collapsed in recent years. You see these diagonally black and white bars have become extremely small. So since COVID, I think it's a general story. The US have used the shift to work from home and sort of the labor market consequences of the pandemic to really reshuffle and gain productivity. There might be structural factors at work as well. There's economies of scale and services and digital services that we have not captured in Germany, but we've also have a big problem with obviously bureaucracy, regulation, and also sickness leave. So something is a little bit broken in the German economy in terms of productivity growth in recent years. We are cautiously optimistic that some of this might come back. You see, we predict going forward, but that is going to be balanced or negatively balanced going forward by a very adverse trend on the labor market if and that's an if the migration policy, speaking about skilled migration into the labor market, does not change meaningfully. So we're still at a potential growth rate at maybe 50 basis points, 60 basis points per year, provided that the labor market situation doesn't meaningfully change. Migration is one of the sticky issues. There is two kinds of migration. One is a humanitarian migration, and one is a skilled, economically beneficial opening of labor markets in certain areas. I don't know about the Italian situation, but in Germany, these two get combined in the public mind and make it very hard to open the country for the kind of migration that is economically not only sensible but necessary to sustain prosperity and growth going forward. Otherwise, you see that from 2028 on, Germany will, at least in this accounting sense, start the year with a growth with minus 0.4, minus 0.5 each year, just because we lose workers. Let me leave it here. The demographics are what they are. You know that there's some immigration, but we're still not very good at pushing up in this international competition for skilled labor and to get to meaningful immigration rates that we would need roughly 500,000 per year net to compensate the loss of the German labor force. Okay, and that's it. Participation rates, nothing big going on, and I leave it here. I'm happy to discuss. Maybe leave it on this slide because I think it's the most important going forward. So on the structural side, potential growth, still a lot of headwinds on the business cycle side and potentially on the industry technology side because of the defense and maybe also because some of the infrastructure boost. Certainly a new Germany and some more short-term upside than usual. Thank you very much for your time.